Hello, I'm Mark Sobel, U.S. Chair of OMFIF, and also a former Treasury Deputy Assistant Secretary for International Monetary and Financial Policy and IMF representative. And today, I have the great honor of returning to my former stomping grounds and being in the historic and ornate Treasury Cash Room, one of the last rooms built in the Treasury, completed in 1869 in time for Ulysses Grant's inaugural ball, and then used until the mid-70s to provide various financial services to the public. I'm here with Brent Neiman, the U.S. Treasury's Assistant Secretary for International Finance. In this position, Brent is one of America's leading international financial diplomats. As Assistant Secretary, Brent engages in a broad variety of international economic priorities, including our response to Russia's brutal war in Ukraine, cross-border debt issues, IMF governance and programs, global financial regulation and supervision, digital assets and cross-border payments, and of course, key bilateral issues with various countries, including China. Brent brought a wealth of talent and knowledge to his current position. Before joining the Treasury Department, Brent was a professor of economics at the University of Chicago's Booth School of Business, focusing on international macroeconomics, finance, and trade, and he also served in a prior stint at the CEA. Brent is going to speak to us today on the International Monetary Fund and then take a few questions from me. So, enough from me. Brent, I'm looking forward to your remarks.
Thank you, Mark. Appreciate you being here, and I always learn something from you, including just now on the history and use of the cash room where we're at, so thank you for that. It's October, and here in DC, that means it's the time for the annual meetings of the World Bank and the International Monetary Forum, the IMF. And for me and my team here at the Treasury Department, that's like Christmas or perhaps the Super Bowl. Finance ministers, central bankers from all over the world come to town. Secretary Yellen meets counterparts, think tanks and investment banks hold workshops, distinguished academics debate various hot topics. It requires an immense amount of work from our teams, but it's great. And the annual meetings are also a time to review the international economic policymaking process. One of my core responsibilities is to help oversee our relationship with the IMF. It's an institution that lends out tens of billions of dollars each year, with that lending tied to economic policy advice, and often with the goal of helping countries avoid or recover from crises. And the IMF is clearly one of the most impactful elements of our global financial system, so it's important to take these moments to reflect on how to make it work even better. In that spirit, and toward that end, I wanted to kick off the season with what I'll consider to be 5 underappreciated facts about IMF policy and governance, how it's run, and what I think we should do about them. So let me start. Fact number 1, the IMF staff and the IMF board are too polite. Don't get me wrong, I'm a Midwesterner, I love politeness. But Keynes is reported to have said that the IMF had to serve as a ruthless truth teller. And I agree that it should do so even when it's uncomfortable, both for its borrower program countries and also for official creditors that are also members of the IMF. For example, the fund often lends based on promises made by official bilateral creditors to either forgive debt or offer new financing. These promises are referred to as financing assurances. But even though these assurances can be critical, can be central to hold the IMF program together, the details on them, who gave the assurances, when, in what form, and any failures to deliver on these commitments or to deliver on them on time are not always publicly discussed, but we think that they should be. In recent years, programs in Argentina, Ecuador, Suriname, for example, all moved ahead on the basis of financing assurances that either were never delivered or were delivered only with significant delays. And these were not things that were addressed other than in passing by the fund. Just this past year, I traveled to Quito and Islamabad to discuss with their reform-minded finance ministers the possible design of new IMF programs for Ecuador and for Pakistan. In both cases, real resolve and decisive action will be needed to sustainably improve their fiscal situations, and the path of their adjustment will depend on the delivery of official financing. And yet, as with the earlier programs, the fund's papers on these new programs were similarly polite. In the case of Ecuador, China has not provided financing assurances beyond what's required, which is the first 12 months of the program. Rather than plainly detailing the risks that this implies, including mentioning China by name, the program documents obliquely state that authorities are in discussion with their main bilateral creditor. And in the case of Pakistan, program documents describe the total pooled financing coming from official bilateral lenders, but don't offer a creditor-by-creditor breakdown. We strongly support both of these programs, but for insiders and outsiders alike, this politeness can obscure key factors determining a program's success and can reduce the incentive for creditors to deliver and ultimately to honor their assurances in a timely manner. Helpfully, the IMF recently took some positive steps to fix this. Financing assurances reviews will now be more intensive in programs involving debt restructurings. This is an important improvement, but why stop there? A clear articulation of the details around financing assurances makes sense in all programs. I hope the fund rigorously applies this new policy, plainly characterizes the relevant promises that are made and fulfilled or unfulfilled by official creditors, and ultimately considers expanding its application so this new policy becomes standard practice across all programs. Another area where brutal, if impolite, honesty will be increasingly important relates to the IMF's precautionary lending programs, notably the Flexible Credit Line, or FCL. Countries that the IMF staff and board judge to have very strong macroeconomic fundamentals and high institutional quality, with sustained track records of sound policies, can pre-qualify for access to financing. These countries can then draw down that line if needed without undertaking any required reforms or meeting other conditions, akin to a credit line from a bank. To date, 6 countries have had these FCLs, and some can be quite large. Mexico's FCL in 2016, for example, totaled nearly $90 billion. Now, last year, the IMF staff recommended that up to a size limit, these be treated as permanent, subject to periodic board renewal, with no expectations or encouragement of qualifying countries to drop their credit lines. After all, countries pay a fee for these lines, and their strong macroeconomic positions and institutions merit a conditionality-free facility. The United States was proud to support this recommendation by the fund staff, and it's good economics for countries to be able to purchase insurance in this way. And it's, in our view, appropriate for the IMF to be the institution to provide it. But this new policy will only constitute an improvement if the IMF staff and board do not politely rubber stamp requests to renew these credit lines, and instead seriously assess whether the country in fact remains qualified. If policies or politics or even shocks beyond the country's control impair its economic situation or governance so the borrower should no longer qualify for the credit line, the fund must be prepared to acknowledge this. The fund is also sometimes too polite when it comes to its surveillance responsibilities. For example, as described in its Articles of Agreement, the IMF was established in part to facilitate the expansion and balanced growth of international trade and to maintain orderly exchange rate arrangements among members and to avoid competitive exchange depreciation. However, if you read Fund Article 4 reports, you'll find that these sorts of topics get less attention than we feel they deserve, including in globally significant economies like China's. For example, the IMF does not publicly comment on the role of state-owned banks in managing China's exchange rate, or on why changes in the PBOC, the People Bank of China's balance sheet, don't line up with reserve transactions in China's balance of payments data. And while the fund has built admirable expertise in compiling alternative measures of China's local government debt, far beyond what authorities publish, it has neglected to apply the same analytical rigor to quantifying China's industrial policies. Finally, we the shareholders are often too polite when we vote on programs. It's very common at the IMF board to abstain rather than to vote no to express disagreement. Why are no votes so rare? Well, it makes sense that early engagement between board members, staff, and the IMF leadership would mean that most programs only reach a vote if they command broad support. But still, it is important for the good functioning of any organization to have the ability to clearly voice opposition in a non-stigmatized way that is also reflected in the final tally. So while I still expect it to be a very rare occurrence, I'm convinced that there are times when IMF members should ignore the niceties of an abstention and vote no rather than accept a weak or problematic program. On to fact 2. The IMF is sometimes too risk-averse. Given the IMF's role as a global lender of last resort to troubled economies, it may not shock to learn that in many ways it and its board have a very conservative approach to risk. And for the most part, that makes sense, and that's what we support. But there are a few ways in which, by slightly relaxing its approach, the fund may be more effective in accomplishing its mission. One example is the fund's perspective on the possibility of having to tolerate some period of arrears. If the alternative is making disbursements to an off-track program where a country has not completed needed reforms, the IMF must choose arrears. The threat of arrears should not outweigh the need to maintain high standards. Only by designing strong programs and standing firmly behind required conditions can the IMF credibly affirm that countries are on a sustainable path. If a program is clearly off track and disbursements are made simply so the country can pay back the fund, it may in fact worsen the poor performance and make ultimate repayment even less likely. Such behavior could also reduce other countries' motivations to enact reforms and keep their own programs on track. Another example is the fund's heavy reliance on co-financing from official bilateral creditors and multilateral development banks, rather than having larger exposures of its own. Co-financing certainly has its benefits. It can help share risk. It can help marshal pressure and advice from creditors to help the borrowing country adjust. But there are downsides as well. Countries on the brink of macroeconomic disaster are sometimes forced to go hand-in-hand to bilateral creditors, which are often hesitant to lend more. And in the worst cases, creditors use their significant leverage over the debtor, which correctly views the creditor's co-financing as key to advancing their fund program. Though a more thorough analysis should consider factors such as the scale of the shocks, hitting program countries, and compositional differences in program recipients, by some metrics, it appears that the size of IMF programs might be declining. Financing from the fund averaged about 1.5% to 2% of GDP in the 1980s and the 1990s, before jumping above 3% during the global financial crisis. Average program sizes have since fallen to about 1% of GDP during the past few years, a period during which we assessed that some IMF programs were potentially too small and potentially relied too much on co-financing. The IMF should keep a careful eye on this dynamic and in appropriate cases increase its own exposure with bigger programs and a commensurate increase in associated conditionality and required reforms. In this vein, we welcome a review on the IMF's exceptional access policy, which was last reviewed more than 20 years ago, to make sure that the IMF is bearing risk appropriately in these critical cases. The IMF and its shareholders should also think through other possibilities to get more out of their existing resources. It should continue to guard its rock-solid balance sheet, a bedrock protection that we and other major shareholders have long relied on to keep lending costs low and predictable. But the IMF's precautionary balances, which is the buffer that it keeps to protect against large-scale defaults on its lending, significantly exceeds the fund's target. As such, the fund might consider using some of these excess funds to shore up the sustainability of the Poverty Reduction and Growth Trust, which is the IMF's tool to lend concessionally to low-income countries. Lastly, earlier this year, the IMF helpfully completed a review of its lending into official arrears policy. The updated policy will afford the IMF with new options, in some cases, to move ahead with programs even if a large creditor does not agree to restructure its debt along with other creditors in a timely manner. Though such cases inherently involve more risk to the fund, we encourage the IMF to use this new policy and deploy it when needed to support its membership. On to fact number 3. Not all financing flows supporting IMF programs are created equal. In April, Undersecretary Jay Shambaugh gave a speech in which he spoke about the U.S. vision for global debt and development finance, which has since formed the basis for the Nairobi, Washington vision. He called on the official creditor to provide net positive financing flows on a coordinated basis in support of borrower countries with IMF programs. If resources flow out of countries trying to pursue appropriate reforms, they may have to forego needed investments for their development, and they'll have a harder time keeping their programs on track. Our hope is that official bilateral creditors, who are themselves IMF members and part of a global community aiming to support development, collectively maintain their financing support to countries during a program. That would be the right thing to do. The vision specifically calls for new support to be transparent and readily accessible. And the reason this is so important is that not all financing flows are the same. In particular, the purchase of strategic assets or the extension of opaque project lending with conditions attached, such as requirements on how inputs are sourced or which labor is used, are generally not in line with this vision, even though they may technically still result in net inflows to borrower countries. Bilateral swap lines that carry onerous use restrictions or where the terms are not publicly discussed are also not generally in line with the vision. And IMF data on gross reserves often include the value of PBOC swaps, even though such swaps often come with opaque restrictions on their use and potentially do not satisfy the IMF's rule that reserve assets must be readily available and controlled by the monetary authorities. IMF country teams have approached this issue in different ways. In the case of Sri Lanka, IMF staff have noted in footnotes that the central bank's PBOC swap assets are currently unusable. For Laos, fund staff indicated in a footnote that it is uncertain whether swap assets are tied to specific purposes, but that if the swap disbursements are tied to specific uses or not under the full control of the central bank, then they should not be counted as reserves. In Suriname, staff created a usable gross reserves category that excluded the PBOC swap, while still counting the swap assets toward gross reserves. Meanwhile, in Argentina, staff have continued to accept Argentina's own classification of its full PBOC swap line in its gross reserves, but staff exclude the unactivated share of the PBOC swap from their estimates of Argentina's FX liquidity. This confusing and inconsistent treatment partly reflects a lack of reporting by the PBOC on the details of each of its swap arrangements. The IMF's treatment of swaps should be consistent and compliant with its stated policy when it calculates reserves, analyzes debt sustainability, and secures financing assurances. Collectively, we should continue to cultivate enthusiasm and secure commitments from the official sector to invest in support of fund programs. But we must make sure the result is the expansion of transparent, credible, and on-budget financing flows or debt relief to countries undertaking reforms, not potentially damaging forms of lending. On to fact number 4. Third-party providers can sometimes help IMF programs, but sometimes can't. Supporting low-income countries, including those covered under the fund's fragile and conflict-affected states strategy, or where a government has a history of misuse of funds, is one of the most important things that the IMF does. But programs in these countries are often also the most difficult, because the IMF must minimize any chance of unwittingly abetting the drivers of corruption, violence, or illegal activity. In these cases, the IMF has sometimes appealed to third-party implementation as a way to spend funds or administer reforms without overly relying on government or other risky actors. This is generally a good idea if the third party is assessed to be more transparent, more efficient, or more law-abiding, then it is by construction a less risky way to provide critical government services or to address urgent humanitarian needs than simply cutting a check to the local authorities. But we must remember that money is fungible, and this means that third-party implementation is no panacea. Imagine the IMF wishes to support a country whose budget has deteriorated due to rising prices of social spending, but where it worries that the government might misdirect IMF resources, let's say to buy weapons. Giving money to a third party may not help in this case, even if that third party faithfully and transparently implements, as promised. After all, with that social spending now off the government's budget, the government's fiscal constraint will be relaxed, and it can simply allocate or reallocate that amount of money however it would like to. Third-party implementation will be most effective and is more likely to successfully act as a safeguard when it is designed to perform a service that the government would otherwise not be doing, or where it can be additive to the government's efforts, rather than simply substituting funds so the government can shift its spending. Given the importance of the IMF's work in fragile and conflict-affected states, and given the subtleties of this issue, the IMF should consider developing a policy on when and how best to use, or when not to use and to avoid, third-party implementation. Finally, the last one, fact 5. The IMF has a really tough job, and thankfully has great people doing it. Perhaps I should have started with this one. I've just encouraged the fund to communicate more directly even when uncomfortable, to take more risk in certain situations, but to be extra careful when doing so, to be nuanced in discerning which financial flows to encourage and which to discourage, and to actively deploy safeguards while staying attentive to their limitations. Each issue is obviously subtle and tricky. Like I said, the IMF has a really tough job. But luckily, the fund's staff are passionate, hardworking, well-trained, and dedicated caretakers of the international financial order. They're open to feedback and more than capable of pushing back when that feedback is off the mark. At Treasury, I have a fantastic and experienced team, deep in the issues and able to brief on macroeconomics and macroeconomies all across the globe. Even still, while preparing to visit a country, I find the advice of the experts at the IMF and its Article 4 surveillance reports to be an obvious first stop and an indispensable high-quality resource. I can't think of another institution as successful as the IMF in promoting stability and growth and spreading macroeconomic expertise around the world. And it's now been doing so for more than 80 years. I'm confident that with continued support and commitment to the institution, and with occasional tweaks to its policies and governance, the IMF will continue to do so for a long time to come. Thank you.
Thank you. Well, those were great remarks. Since I'm sitting here, I certainly want to echo your words of praise for the outstanding IMF staff, many of whom I've gotten to know closely over the years, and especially your words of praise for Treasury's wonderful, smart, and talented international affairs staff, many of whom are close colleagues and friends to this day. But let me throw a few questions your way. Let me be start a bit philosophically. You said the IMF was a global lender of last resort for troubled economies, and you endorsed the IMF's role in providing unlimited insurance for strong performers, which he noted also can pose a major claim on IMF resources. Now, for me, insurance and lending are two different business models. During the pandemic, the fund reasonably provided low conditionality or unconditional support to several countries, and that made sense because it was kind of an exogenous liquidity shock. But many in academia and other nations call for the IMF to play a bigger liquidity role, ramping up its swap facilities for EMs, SDR allocations, including for climate and or development purposes, more precautionary support, even for those facing difficulties. And put differently, they seek to have the IMF play a larger global lender of last resort role. Now, your speech alluded to it. You know that judging when countries mainly need liquidity support or conditional BOP support, conditional balance payment support, can be difficult. IMF members face differing needs. In my view, countries that get into trouble by and large do so because of poor and inadequate policies, and they need to adjust. So I guess the question I have is the world asking the IMF to wear too many hats, and should the IMF emphasize more its role as a conditional lender?
Well, thanks for the question. I might answer in a somewhat more narrow way than the question might otherwise direct us, but look forward to a broader conversation on it. But I should clarify, you say unlimited support in these precautionary programs like the FCL, and I do want to clarify, the reform that that Treasury supported, that the IMF put through, puts very clear limits on the scale of this precautionary tool of the flexible credit line that would be considered permanent, where there would not be an expectation. And we would not support an unbounded scale of that program. And the quantitative example I gave actually is not in reference to the limit on the extent to which the flexible credit line can be considered permanent. You said, lending and insurance are different business models, but they're certainly related. The reason that a bank in the Midwest gives its manufacturing clients both a loan and a credit line is that the kind of expertise and information and insight about the borrower that would lead them to be able to approve the loan also might allow them to best judge when a client is suitable for a credit line. And I view the IMF's role here is very much in that way. It is well placed to seriously assess whether a member country should qualify for a conditionality-free credit line like the FCL. All this, of course, hinges critically on exactly what I was trying to focus on in my speech, that in fact that vetting is really taken seriously. And this vetting has to continue to occur even for countries that have at some point in the past received a flexible credit line. And so part of the speech was a call, we're supportive of this new policy, but a call to take very seriously the responsibility to call it out if a country moving forward is not qualified for it. The broader issue on what should the fund do, to what extent should it be focused on conditionality versus liquidity, is in fact a big issue. Jay Shambaugh's speech last year touched a bit on the difficulty that the IMF faces in being pushed and pulled in many different directions and trying to potentially do too many things. But here today, I did just want to focus on this particular element of liquidity provision, insurance provision, which we are happy to support, so long as it comes with, like we said, ruthless truth-telling on who should qualify and who should not.
Okay, well, we can debate this further one of these days. You didn't mention IMF quotas. First of all, I know there's legislation on the Hill to implement last year's quota deal. I'm sure that's very important to the Treasury Department. More generally, the purpose of quota increases is to ensure the fund has adequate resources, but quota increases are also used to adjust shares to broadly reflect relative weights in the global economy, not exclusively, but broadly. Now, the IMF, to me, seems to have ample liquidity, but I also think, looking at some of the shares, that Europe is overweight, several East Asian countries are underweight, including China, which is 6% of the fund and maybe 18% of the global economy. I've argued some share adjustments are needed, especially to modernize the fund's weighting, provide greater legitimacy for the fund's multilateralist vision, and help forestall moves towards financial regionalism. So there's always debates about quota formulas, and quota increases are always being discussed for the future. So what's your take on quotas and shares?
Right. Well, so quotas sort of do two things, as you noted. One is it determines what resources are available for borrower countries to tap into from the fund. And starting with that side of things, we're very supportive. We think that this package that was passed at the IMF level and now hopefully will be passed or authorized by Congress is really important for the IMF's lending capacity. The quota, coupled with access limits, governs the extent of borrowing that countries can do, and we think this is important. The total amount of IMF lending resources, as you suggested, under the proposal would not meaningfully change, because the proposal involves an increase in the quota and an offsetting decrease in other more opaque sources of capital that the fund has used. And so we think this is also a positive thing from the governance perspective. We say it makes the IMF more of a quota-based institution, which is certainly how it was designed and how we think it will more effectively and transparently run. But turning next to the side of a quota change, which is that it governs who has essentially voting shares to what extent. And here, Treasury's position has long been, as you mentioned, that there should be a formula underlying any change in quota shares. There certainly are principles that the membership needs to converge on that would determine who should have more or less voting shares. And those principles, though, need to be embedded in an agreed formula. And absent that formula, since we were unable to reach agreement recently, the fund agreed to move ahead with what we've referred to as an equiproportional increase in quota, where the voting shares haven't changed. And so, I think it is really important, as you suggested, that this package is authorized by the U.S. Given our very important role in governance of the institution, absent Congress authorizing this quota package, it won't go through at all. And we do think it's a really important way to keep the IMF functioning well at the center of the global financial system, to demonstrate U.S. values and leadership. It's one of the best tools that we have to make sure that the global financial system remains stable and sound, and to propagate values that I think we've long tried to maintain in the global economy.
Well, good luck with the legislation. Very important to U.S. credibility, as you underscore, having witnessed long delays in the past that I lived through. Many low and lower income countries face debt distress. What's new is that official creditors, and no longer the Paris Club members, are often major creditors, along with the private sector. China is frequently a major, if not dominant, official creditor. The IMF has played an active role in tackling distress through its programs, but also through its work in the G20 Common Framework, its Global Sovereign Debt Roundtable, and in particular through its debt sustainability analyses. While it has often taken very long to secure financing assurances, as you alluded to in your remarks, that process, I think, seems to be moving more quickly. But debt-distressed countries, in my judgment, are often being left with too big debt burdens, and more relief and NPV, net present value reductions, might help countries overcome debt overhangs and avoid perpetual cycles of refinancing. So what's your take on the IMF's role in this nexus of issues?
I mean, we've, I'd say over the past 2 to 3 years that I've been at Treasury, the changing landscape of international creditors has been perhaps the first order issue when thinking about, global debt, the role of the international financial institutions, and some of the challenges that we face now that perhaps we didn't face, decades ago. There aren't many data points to evaluate at high frequency how that landscape is changing. But you asked about the IMF's role in all this, and I do think one of the important roles and successful roles that the IMF has played is as a convener, essentially at the center of this system. One example I would give is, together with the G20 presidencies, past and future, the IMF and the World Bank convened the Global Sovereign Debt Roundtable, which was a forum that I think helpfully brought together borrowers, creditors, private creditors, official creditors, and tried to make progress on some of the issues that appeared to be slowing things down in terms of debt restructurings and debt impasses. And I agree with your assessment that there appears to be progress, although we hope it's sustained and in fact increases moving forward if and when we get more cases. Beyond that, the IMF serves a key role as essentially providing the analytical grounding for where any sort of treatment or progress for program countries that the IMF's analysis basically lays out what is the target amount of debt that a country can sustainably bear. And that target becomes an important focal point for negotiations between the country and creditors and the IMF. And so there's quite a lot that hinges on its judgment there. One thing that is important that there's been a lot of commentary on is how the IMF uses different frameworks, for example, to cover different kinds of countries. There's a debt sustainability analysis framework that's used for low-income countries, others for market access or middle-income countries. And it has been observed that some countries that may be quite close to the margins between these two treatments can often find themselves in very different positions after an agreement and at the start and end of subsequent IMF programs. So as the IMF, and it frequently does, reviews its debt sustainability analyses and frameworks, keeping an eye on these sorts of jumps, understanding where they might make sense, what should be taken from one framework and imported to another, seems really important to us and is something we'll continue to engage with the fund on. Your very broad point about there being a trade-off that when debt sustainability ratios are set higher, it can favor one set of stakeholders and lower can favor another is obviously a very difficult and in many ways almost literally zero-sum issue. So I don't have any general reactions to that other than it's important to continue to refine the analytical frameworks that the fund uses to determine those paths.
Okay. I hope for more rigorous DSAs that avoid perpetual recycling, refinancing cycles. But another IMF topic is the SDR, the special drawing right. So it's an unconditional reserve asset allocated for the purpose of meeting the long-term global need to supplement existing reserve assets. I think that's the language in the articles. And their SDRs are allocated according to quota shares, so they end up going to large advanced and emerging market economies, often sitting on those countries' books. There was a fresh allocation after the pandemic, and arrangements were made, novel arrangements, to rechannel some of them, to put them to use rather than just sitting on books. The rechanneling was for the IMF's low-income lending and a climate-related resilience and sustainability trust. And more recently, I think, for some hybrid capital instruments to leverage lending for the African Development Bank and the Inter-American Development Bank. So there's also a raft of other proposals, the Bridgetown Initiative, et cetera, to have frequent allocations to use them more broadly. And so I guess, how do you see these proposals, and do they comport with the role for the SDR specified in the IMF articles?
Look, I agree with your use of the word raft of proposals. There's been quite a lot of creativity, and as a result, a lot of proposals that have come through, some which we find more promising, some which we find less, and I won't use this forum to weigh in on the specifics of any given proposal. We, of course, take them all seriously and give them due consideration. But what I thought I would instead talk about here is clarifying that a lot of these proposals, or more importantly, the commentary around the proposals, treats some of these rechanneled SDR proposals as if it were grant money, as if it were a transfer of fiscal resources to help, let's say, lower income or middle income countries. And in fact, SDRs are different. If a country uses its SDRs for, let's say, some spending purposes, it has to exchange them, convert them into hard currency. And once spent, then, it essentially pays an interest rate on those SDRs until it returns to the balance, the level of the SDRs that it was originally channeled or that it originally has a quota for. And so, in that sense, you want to think of it as the extension of, potentially lower cost lending, but still lending. And sometimes, under some proposals, it might be good for low-income countries to have access to more lending, but sometimes it might not be. And that's the lens through which I think we need to really remember and evaluate these kinds of proposals. Further, I mentioned earlier in my remarks the Poverty Reduction and Growth Trust. And it is also worth noting that low-income countries do have access to lending from that trust, actually at more favorable terms, at zero interest rates and for long maturities. And so again, I think it is important when thinking about and evaluating these rechanneling proposals to think of it relative to the alternatives, some of which might be better for the borrowing countries, and also not to treat it as if it's free money, as if it's grant money. It is not.
The SDR, of course, is an unconditional reserve asset, whereas PRGT lending involves conditions. But let's throw one last question at you, picking up on where you were. So there have been major debates lately about IMF surcharges. Many progressive voices in certain emerging markets have called for dismantling them. To me, it makes sense that a financial institution would charge more for large-scale, higher-risk lending. As you said in your remarks, the fund's capital base, its precautionary balances, are quite high, though the IMF always faces ongoing risks. There are major subsidy resource needs for the fund's low-income lending, as you just said. And I just, as a longtime fund observer, I think it's absolutely critical that more grant resources, subsidy resources, be given to the PRGT to maintain a higher self-sustained lending limit. So would it make sense perhaps to reduce the rate on surcharges, transfer some ongoing surcharges income to the fund's low-income lending facility and rebuild up the fund's capital a little bit more given massive risks in the global economy? Would that be a kumbaya moment for the world?
I mean, just start by saying I think I agree with. I took you to say you're supportive of surcharges at some level, and certainly we agree. You talked about large scale, high risk, and surcharges are triggered by there is some room to help alleviate this burden that's putting on certain program countries, in fact, in a way that might make those programs more likely to succeed while still keeping the level of surcharge income earned as a share of total borrowing basically at its historical level, which, as you introduced, we agree is important. So I think there's some scope, some room for improvement in policies in that direction, and I don't know about a kumbaya moment, but hopefully we'll find a good landing spot for that.
Well, great. You've been very generous with your time. I want to thank you for a tremendous set of very thoughtful remarks. And I want to wish you and IA staff very successful annual meetings. So thank you, Brent Neiman.
And thank you to you. Really appreciate everything you do to keep global attention on these issues and to be with me today.